Did you know that a whopping 70% of small businesses in Australia are structured as sole traders? That's right, the simplest structure is the most popular, but is it the right one for you? Welcome to Dollars and Dreams, the podcast designed to empower you to take control of your personal and business finance. You know, the very thought of money and finance can often send chills down your spine and stir up fear of the unknown. But let's change that narrative together. Through this podcast, my goal is to not only to provide you with useful information, but also to inspire and motivate you to take action towards your own financial goals. Let's rewrite your money story together. Hello and welcome to today's episode of Dollars and Dreams. In today's podcast, I'm going to go over one of the most common questions that we get asked all the time, and that is, what is the best entity for me to trade in with my business? And of course, there's no one size fits all. If there was, it would be a nice, easy approach. So in today's episode, I'm going to break down the pros and cons of those four main entities that we have in Australia, which is sole trader, a partnership, a company, and a trust. But not only am I going to break down the pros and cons, I'm actually going to go through some of the limitations and some of the businesses that are most suited for each of those trading entities. There is a lot to cover here, and of course, with everything that I do, I really just want to give you the knowledge so that you can make informed decisions. You should, of course, talk to your accountant, or you can reach out to us here at jenrichardson.co if you have more questions around what suits you. Because what is best for you may not be best for your friend. And one of the things we hear quite often is, well, my friend's got a company and they said that's the best thing because, and they rattle off all these things. Or my next door neighbour said they run their business through a trust, so I want a trust. There is nothing that says this is always the best. There are circumstances that need to be taken into account, and of course, as I said, the pros and cons. So in today's episode, I will go through all of that, but if you want to know anything more, I've created a resource called The Pros and Cons of Different Entities, a comprehensive guide, and you can find that in the notes where you're either watching or listening to this podcast, or of course on our homepage, which is jenrichardson.co. So firstly, the one thing that I want to get you to take out of your mind is that a lot of people will say whatever entity you start in, you're stuck in, and that's not the case. And whilst we always say that you should create the entity that is going to best suit your future direction, if you're still tossing up whether you want to be in business, or maybe you just think, oh, I'm sick of working for somebody, I'm going to go and have a go at having my own business and see if I like it. Because business isn't for everyone. And we've had clients over the years that have gone into business, and after a couple of years, you know, they might be making good money, but for some people, the stress that comes with it, all the added stuff and never finishing work, really. Sometimes that just gets too much for people, and they say to me, I've actually just don't love being in business. I just want to go back and work for somebody. And so you want to be very careful that the structure that you put in place when you first start isn't a really expensive and a really difficult one to put in place if you're not really quite sure if business is what you're going to be. It's also important to realise that whatever business entity you start trading in, if at any point you start to grow, you need asset protection, you can always change that entity. Or perhaps you're at the other end of the scale and you're now starting to wind your business back, you can always drop down to one of the lesser ones. So there is lots of different things that you need to take into account with all four of those trading entities. And of course, as I said, there is no right or wrong approach. It's what is personalised to you and you only. I actually had a client came in the other day and said to me, Jen, I need a family trust. And I thought, it's a bit odd. I didn't think she was in business. I thought, she was still working for somebody. Anyway, when she came in, I said to her, have you started your own business? And she said, no, but my next door neighbour's got a family trust, so I thought that's what I should have. So that person had just taken something that the next door neighbour was doing, but they were actually running a business through their family trust. She just thought that anybody could have a family trust and you could just put everything in it. So it's important to understand that you need to make this decision on your own personal circumstances, the thing that is right for you and your family and your own business. The other myth that we quite often hear is that I need to be a company because I can claim so much more if I'm a company. And that's not the case. Rarely is there any deductions that are available for one entity that wouldn't be for another. Because under our taxation legislation, the expense that you want to be able to claim is that there has to be a connection to your income earning capacity. Doesn't say that there is a connection to a type of entity. We also hear people say to us, if I form a company, I can have a company car. You can, but there's lots of other ramifications that come with that, and it doesn't mean that all of a sudden your family car is tax deductible. So please don't think you're making a decision with what type of entity around what is tax deductible, because that's not the case. So let's start with the first one, and it's a sole trader. And as I said in my introduction, this is where most people have their businesses. So a sole trader means that you are using your own tax file number. So the income is reported in your own personal income tax return. The business is you. And we will quite often have people come to us and they say, I've done my own tax return on MyGov, but I need you to do my business's income. And then when we start to dig into it, they're a sole trader. And so that business is part of their own personal income tax return. And it is important to remember that as a sole trader, you will declare any salary and wages, any interest, dividends, rental property income, but also your business income. It also means that you pay tax on whatever income your business generates. And I should say that I'm talking about taxable income. I'm not talking about gross income. So the thing that we find with a lot of sole traders is if they've bought equipment, of course, that doesn't necessarily become tax deductible in the year that you spent the money. And this isn't a podcast about what's tax deductible and not. So we're just going to leave that there at the moment, that some equipment that you buy may not be tax deductible. So the money has gone out of your bank account because you've bought that piece of equipment, but it doesn't form part of what we call your profit and loss. So we quite often get people say to us, but you're telling me my profit is $100,000, but there's only $50,000 in the bank account. And so you will pay tax on the profit and loss taxable income, not what's in your bank account. So if you're a sole trader and you have those circumstances that I just talked about, that there's $50,000 has gone off to buy a large piece of equipment, you've got a profit of $100,000 and only $50,000 in the bank account. So we're just taking very simple scenario there. You will pay tax on the $100,000 because that is your profit from your business, even though there's only $50,000 sitting in the bank account, because the other $50,000 is sitting as an asset which is on your balance sheet. That means you're paying tax on $100,000, but you've only got $50,000 sitting in a bank account because the other $50,000 is sitting in some supplier's bank account. You're going to pay tax, and I'm just going to pluck a figure out of the air here. Let's say that's $35,000. You will then say, well, I've only got $50,000 in the bank account, but I'm going to pay tax of $35,000. How does that fare? That's because as a sole trader, you are paying tax on everything that the business makes, not just what you get to keep. And that's a very important distinction that comes with a sole trader. The other thing that you need to keep in mind is that if you're trading as a sole trader, your business and the debts of that business are your own personal debts. And so if your business doesn't go well and you have to close and you've got suppliers that you haven't paid, that's going to come out of your own family's bank account. So it does mean that operating as a sole trader, your assets and your bank accounts are on the line for the business. So it's what we call unlimited liability. And so that is one of the downsides of sole trader. The tax implications, as I said, it comes into your tax return based on the profit and loss, not the cash that's left in the business or the cash that you've taken out of the business. And that will come into your tax return and you will pay tax in your own name. Potentially, if your business has, the highs and lows that some businesses do have, you could have some years that you pay a lot of tax because it's pushed you up into high tax brackets, and other years where potentially your income will be quite low and therefore you don't have a huge income tax rate. And it means that you can't level those out. Whereas if you're trading in some of the other entities, we'll talk about those a bit later, you can actually level out that income a little bit more. The simplest of those is if you're a company, you take a wage, so money can stay in the company and the highs and lows can get leveled out a little bit. So there is a potential for cash flow issues if you are a sole trader and running your business. So they are the cons, I guess, of running a business in your own name. The upside of running a sole trader business is it's probably the easiest to look after. There's no complex legislation. You don't have to abide by a lot of government rules other than the tax office, of course. It can be simple, as in the accounting fees are generally lower for a sole trader than they will be for the other types of entities. But also because it is simple. Whatever the money comes in, whatever's left is yours, and you can use it how you like. If you're in other types of entities running your business, then you have a lot of legislation that we need to work with. So the nice, simple entity to trade in, of course, is a sole trader. The downside, of course, is you have fluctuations in tax, you have unlimited liability if something happens and you go wrong. So they're ideal for businesses that are in early startup phases. They're ideal for businesses that are freelancers or consultants, and so where there's not a lot of risk. So we quite often will use these for clients that might go out and just consult to other engineering firms or other technology firms, or people that potentially are just, business coaching. It does only work with businesses that have low risks. Rarely do we say a sole trader should be anybody in the building construction industry, because there's always a risk there of costs not being covered by your income, and then you have assets on the line. You probably shouldn't have employees, because there's a risk there. If your employee does something, then your assets are on the line. So I need to emphasize that your personal liability is the biggest downside of running a business in your own name. It also can make it a little bit difficult to sell the business later on if it's in your own name. So the next entity is a partnership. Now, a partnership really is just a step up from a sole trader. By definition, it is 2 people up to 50, I think it is, that you can have now under legislation. They always used to be what accounting firms and legal firms ran in, although it's not always the case now. So what a partnership is basically just a group of individuals who have banded together to run a business. The liability to the partnership still flows through to you as an individual. You are also liable for anything that your partners may do. And we've found this over the years in some of the big accounting firms that are worldwide. One group or one office may do something that they get sued for. All the partners around the world have some liability. So there is a separate partnership tax return that is done, but a partnership doesn't pay tax in its own right. So what happens there is the profit of the business comes into the partnership tax return. That is then distributed to the partners in the partnership, and those partners will include that income in their own personal tax returns. And it's a little bit like interest on bank accounts. It just comes into the tax return as a distribution from a partnership. In your own personal tax return, then you pay the tax on that income. It does mean that the tax liability between the different partners cannot be connected. So if your business partner doesn't pay their tax, the tax office can't come to you to pay their tax. Once it's gone out of the partnership and into your own personal tax returns, then that is where you pay the tax. So there is still liability. So if your partner, as I said, does something wrong, you are still legally liable. Or if they sign the partnership up for a debt, you are still liable to meet those repayments. You as a partner will ultimately be equally liable as the partner that signed up that debt. So there is a lot of trust that needs to be there in a partnership. Whilst it's not a legal requirement, we always say everybody should have a partnership agreement and a legally written up partnership agreement. The partnership agreement then sets out the terms of what can be done, what happens when you want to dissolve the partnership. Because part of the problem that we see as accountants all the time is people go into a partnership together for whatever reason they don't want to work with each other anymore. And one person wants to dissolve the partnership and the other one doesn't. So how do you deal with that at the other end? Let's say you've got a lot of goodwill or you've got assets. You don't want to walk away from that. If your other partner says, well, I actually don't want to buy you out, how do you deal with that? What do you do? That's what a partnership agreement does. So it sets out the rules of the partnership. It sets out how you can exit the partnership, what happens when you dissolve a partnership, who else can come in. So let's say we've got a partnership with two people and one of the partners says, my friend's got this great ability to do whatever it is that your partnership does. Let's bring him in. And you sit there and you go, I actually don't like that person. I don't want to work with that person 40, 50 hours a week. And you say, well, no, I don't like him or her. I don't want them coming into the partnership. Your partner's sitting there and they're saying, but they've got this unique ability that we could really prosper from. And you're saying, but I don't want to work with them. But they could be really good, but I don't want to work with them. The partnership agreements should set out those terms of what has to happen in that situation. So basically your partnership agreement is the rules of the entity. And it is super important that you get that in place before you start business, or at least in the very early stages of when you start business with somebody, because you don't want to get down the track and it's now trying to get these things resolved, which means you could end up in court. So a partnership still has the same legal liability. There's still no flattening out of the profit. So it's still going to come in. So if you have your high years, your own personal income tax return will be higher and potentially you pay more tax. So there's tax implications as far as it can be difficult to balance the ups and downs. There is still a liability that comes through to you and you personally, and you may be in a higher tax bracket, so it may not be suitable to get that income. There is the legal costs of a partnership agreement. There's applying for a separate tax file number for the partnership, along with all the other associated things such as an ABN. And of course, as I said, the big downside of a partnership is that you have the legal liability of anything that could go wrong. So again, you have what was called the unlimited liability. It can still be quite difficult to run. You can get a limited liability partnership. Don't get me wrong, you can get that. But as a general rule, we don't see that in the small businesses. A company. Now, this is the one that everybody thinks a business is. And you'll hear people talking all the time about their business and they'll say, oh, but my company does this. And I'll say to them, you're not a company, you're a sole trader. They are completely separate. So you can't keep calling your business a company. A company, by definition, is an incorporated entity. And so what we do is we incorporate this structure it becomes its own legal entity. So a legal entity means you can sue and be sued. So once we create a company, we have two different types of company. Firstly, there's a private company or a Pty Ltd, and then there's the public companies, which are just Ltd. The difference between those two is around the reporting requirements, because a public company has to have records that are available to the public. And you'll see those with AGMs with companies. If you own shares in any companies, you'll get notified that there's an AGM. You'll get notified that the financials are there for you to look at. And so they become a reporting entity, which means you have to meet certain reporting requirements. You have to lodge documents with reporting bodies and things like that. A private company is, as it says, private. So you don't have to have your financials available to the general public. You don't have to go through a stringent testing or producing of financial statements. You don't have to be audited. You don't have to submit your financials every year to any government bodies. Once you've incorporated a company, it gets its own tax file number, it lodges its own tax returns. Obviously, it has an ABN. That's no different to sole trader or a partnership. But it will then have to have its own bank accounts. It'll have to have its own insurances and things like that. You will then get your wages potentially, or a director's fee from your company. We always say to everybody, you wear two hats when you have a company. You have your hat on as an employer, but then you have your hat on as an employee. So when you are trading as a company, you become an employee of your own company because, as I said, it's a legal entity in its own right. And you are treated no different to any other employee in your company. So it's as if you were working for wherever you work now. You're still entitled and required to pay superannuation. You have to have workers' comp. You have to have appropriate insurances for your employees. The only way you can get money out of a company is as a wage, or you can take it as a dividend because you will also be a shareholder of your company, or probably a shareholder. So potentially you can wear three hats within your company. You can be a director, you can be a shareholder, and you can be an employee. They are all very different requirements, and you need to treat them all differently. So as an employee, as I said, you get your company as your employer, has to pay your superannuation, it has to withhold tax from your wages, and it has to lodge all the wages and reporting requirements with all the government bodies, including your superannuation fund. You also have to have your superannuation paid on time, exactly the same as it is for all other employees. As a shareholder, you're entitled to a dividend because you've made an investment into your company. Now, that can be a fully franked dividend if your company has paid tax, or an unfranked dividend, or you can get a director's fee because you are a director of your entity as well. A director fee is still liable for withholding for taxes as PAYG withholding, and it is still liable for superannuation. So we have a lot of people that think that, well, I won't get a wage, I'll get a director's fee. That will satisfy the condition. Pretty much, if it walks like a duck, quacks like a duck, it is a duck. So if you're taking a regular payment and it's as part of carrying out your duties as a director, then that's wages. There's no way around that. And so the only person that doesn't get those sorts of things are anybody who is a non-working director. So you need to be very careful when you have your own company that the company bank account is not your bank account. You have to get a wage and you have to live out of your net wage, the same as you would if you worked for anywhere else. Which brings us to the issue that we have quite often with companies, and a lot of people don't get that distinction that the company bank account is not their bank account and it cannot be used for anything other than company business transactions. If you use that company bank account for your own personal expenses, it can create what we call a Division 7A loan. Now, a Division 7A loan is where you owe money to your company. And the tax office obviously don't want you doing that because you've been able to use money without paying tax on it. So they then want you to treat that as a commercial loan. So you need to draw up loan agreements. You've got to charge interest. There's got to be a repayment schedule and things like that. So that can be quite difficult. So at all costs, you do not use the company bank account as your own personal bank account. The tax implications for a company is that they have a flat taxing rate. So the profit is taxed from $1. If you are what we call a base rate company, so that's a company that is trading and it's a small business, they have a tax rate of 25%. Any companies that aren't a base rate company, they pay tax at 30%. If you're a shareholder and your company pays tax, they can pass on that tax in the form of a franking credit. I'm not going to go into that today on what they are because that's just a whole podcast on its own. Just keep in mind that if you have paid tax in the company name and paid a dividend, the tax that the company has paid can pass to you and you can claim that as a credit in your own tax return when you declare that dividend. The upside of a company is that you limit the liability mostly for the business. So with the business, then if it's trading through a company, it will limit the liability to the assets of the company, which mean your own personal assets can't be taken, except if you have done something illegal, you've traded while you're insolvent, and there's a few little other catches as well. But as a technical thing, you need to keep in mind that whatever the assets of the company are on the line. And so you need to be very careful that you don't bank assets there. So if you're in a risky business, we would always say have a separate company with the assets and lease it across to that company so that you don't end up, if something goes wrong, you lose the assets of the business. So if you owned premises, for example, you probably wouldn't want to hold those in the same entity that you trade in. So the limited liability, as I said, is as long as you've abided by everything. Trading insolvent is one of the big issues that we see, and that does mean that the company doesn't protect your own family assets. The compliance requirements are more than they are in a partnership or an individual. You've got an annual filing fee with ASIC, which is just a fee paid to ASIC each year that says that you are still trading solvently and all the records are still up to date. There's lots of requirements as a director to make sure that you do meet the minimum requirements of the Corporations Act. You need to notify ASIC within 30 days or 14 days of some transactions. The requirements of a director is that it is your obligation to make sure that those notifications are done on time. Otherwise, there is some significant penalties and fines. So the tax implications, as we said, is there is that potential that you can balance out the income. So a company under some circumstances can retain profits and pay you a wage to keep that level from one year to another. So you won't have those seasonal up and downs that you can have as a partnership or a individual. So the limited liability is the big pro of having a company, and that's why a lot of businesses that have risky occupations or risky businesses, we will always say become a company, because you don't want to have a house and you lose your house because something went wrong with your business. I was actually talking to a solicitor the other day and he said to me, my house is in my wife's name, so it's okay. But if your wife doesn't generate an income and never has generated an income, then the courts will look at the proceeds of the business, and the proceeds of the business is what built or bought that house. And so there is still a risk that that house could be on the line. So it is something to keep in mind. A company is, as I said, is ideal for anyone who is in a risky business. So definitely building construction industry, anybody that is growing, because sometimes when we grow and we scale our businesses, it does put pressure on our cash flow because we're investing back into our business. And as you know, I always took the sleep test. whether you can put your head on your pillow and not worry about the business, or not worry about, am I going to lose this house, or what happens to the car that I've just bought, and things like that. So talk to your accountant, or as I said, reach out to me here. Don't forget to grab my resource, which is the pros and cons of different trading entities in Australia, and that will go through some of these pros and cons in a little bit more detail. So that brings us to entity number 4, which is a trust. Again, like the companies, there's 2 different types of trust. There's what we call a discretionary trust, and then there is a unit trust. So a discretionary trust, which is probably the most common one, that gives the trustee the discretion as to where the income is distributed each year. A trust, just like a partnership, cannot pay tax in its own name. It is just the vehicle, or think of it like a bucket. The income goes into the bucket, the expenses all come out of the bucket. What is left in that bucket needs to go to what we call the beneficiaries, and the beneficiaries will then declare that income in their own name, just like they did in a partnership. The advantages of a trust, though, is it's the trustee of the trust that's the legal entity, and that can either be an individual or a company. And so we would always put a company in as the trustee to limit liability. Or if you're, again, in an occupation or your business is not a risky business, you may say, what's the point of buying another company, still having all the company regulations? I might as well just be me as the trustee. It does mean, though, that if the trust is sued because it isn't a separate legal entity, it looks then to the trustee, which is the legal entity of the trust. And if that's your individual, your own personal assets are on the line and can be taken. So it is something to think about, whether you want to look at a short-term cost of creating a company with the long-term advantages of stopping your family assets being on the line. So it can be a limited liability entity, because if you have a corporate trustee, so the trustee is a company, it will come to, somebody wants to sue the trust, it looks then to the trustee is a company, there's the limit. If you as an individual are the trustee, it can potentially be an unlimited liability entity, because they'll go up to the trustee, which is you, and all of a sudden your family assets are on the line. It's also a great entity for distributing income to various places. So you can potentially use a bucket company. That means that beneficiary is a company and pay the money to them. The proviso that I need to tell you, though, is in a discretionary trust, the trustee has the discretion where the income goes, but the income does need to be paid to that person. The other one that I spoke about is a unit trust, and a unit trust is a little bit like, I guess, a company. You invest, you buy a unit. The distribution has to go out in the same proportions as the units are held. So if you've got, let's say you've got 10 units out, one person holds 5, one person holds 2 units, and the third person holds 3 units. The profit will be declared 50% to the unit holder that has 50% of the units, 20% to the unit holder that has 20% of the units, and 30% to the unit holder that has 30% of the units. Unit trusts are great where you have unrelated parties that want to create a trust. They're also great if you're using what's called a joint venture, but we're not going into joint ventures today. Unit trusts there is no discretion. It has to go out, as I said, in the same proportion as the unit holding, which is why we use it quite often with unrelated parties, because it means that one person who has a greater voting right can't distribute all the money to their family and leave out the other 2 unit holders. Again, doesn't matter whether it's a unit trust or a discretionary trust, it doesn't pay tax in its own name. A trust, if it runs at a loss, also can't distribute that loss to the beneficiaries. So if we use the example of comparing a business run through a trust and a business run through an individual, if you have an individual that has a loss in their business and it meets what we call non-commercial loss provisions, you can have that loss offset your other income. So if you've got a part-time job and you make a loss in your business and it meets the rulings of being able to claim that loss, then you can reduce and get some of your tax back that you've paid on your wages. If that business is run through a discretionary trust, the loss is captured in the trust. It is offset against future profits, but for now it is stuck inside the trust. So there is that, which is a downside. The trust can be complex because you've got regulations with the tax office. You've got to do a trust minute distributing who's going to get the income before the end of the financial year. So technically before you've known what your profit is. So you'll have to work out who you want the money to go to, and the trustee needs to have a meeting, put that in writing and sign it. And it does, as I said, have to be done before the 30th of June. The days when I started my traineeship, you would wait till you did all the individuals' tax returns, work out who had the lowest tax rate and then distribute to those. You can't do that anymore. So there is a lot of tax planning that does need to be done with a family trust. So it can be a little bit complex. Sometimes you've got to create a company if you want a corporate trustee. So it can be a little bit more expensive. So again, a trust is ideal for family businesses. They're ideal for individuals that want asset protection. It is important, though, that as a trustee, you are bound by the rules of what's called a trust deed. So you get a trust deed when you create the trust, and you need to make sure that everything is run by that trust deed. So there is a little bit as far as the management of a trust goes. So basically, just as a bit of a recap, 4 entities, a sole trader, which is the keep it simple, stupid theory, the KISS theory that we all love. It does leave you open to liabilities. A partnership lets you work with other people and still keep it reasonably simple. There is a greater liability with a partnership than you have as a sole trader, because not only are you liable for your own actions, you're also liable for the actions of your partners. Companies are a little bit more expensive, a little bit more complex to run, but do give you limited liability, which is great if you're in a business where you potentially could have risk. And a trust, again, gives you a little bit more flexibility than a company, but gives you the asset protection. And again, it is complex, and potentially you've got to abide by 2 sets of rules there, because you've got your company rules and then you've got your trust deed. So that's it for me. I cannot stress enough that before you decide to create your business in one of these entities, that you do get advice from your accountant and or solicitor. As I said, I've got a great resource which you can download called The Pros and Cons of Different Trading Entities. And that's, as I said, on our website, or you can find the link wherever you're watching or listening to this podcast. So knowledge is power, as I say. So find out what you need to know before you talk to your accountant or solicitor. And also because then you stop listening to the noise that happens out in the world. So that's it for me. Have a lovely week, and I look forward to seeing you on next week's podcast, or even potentially on Thursday's podcast. Have a great day, and don't forget to grab that download and have a read. Remember, the advice shared in Dollars and Dreams is general in nature, and it does not consider your own personal circumstances. Dollars and Dreams is for educational purposes only and should not be relied upon to make investment or financial decisions. If you need more help, please reach out to a financial advisor for tailored personal advice. Don't forget to click that subscribe button so you don't miss out on future content. And please leave me a review. Your feedback really helps me to reach other people chasing their money dreams. You can find me over on Facebook and Instagram to connect with me. You will find the link in the bio, or head over to my website at jenrichardson.co, where you will find free content and learning tools.